Welcome back to episode 6. Today, we will talk about how to buy and sell debt funds. Think of it like visiting a marketplace. The goal is to buy at the right time and sell it when it works for you. Understanding timing strategy can really improve your investing journey. It's about knowing market conditions, interest rates, and the economy. By spotting the right times to enter or exit the market, you can make smarter decisions that fit your financial goals. Learning this strategy helps you handle market ups and downs with confidence and gets the most out of your investments. And I can't wait to dive in. Let's get started. Think of seasonal fruits at your local market. At the start of the mango season, they're rupees 100 per kilo. As the season goes on and the mangoes become scarcer, the price rises to 150 rupees per kilo. If you bought mangoes when the price was low, you got more value for your money. Later, whether you decide to sell them for a profit or consume them at their increased value, you've taken advantage of the price rise. Debt funds work in a similar way. The price of units, called the NAV, changes daily based on the performance of the bonds in the fund. If you buy the NAV when it's low and rises later, you stand to make a profit. Understanding these price movements helps you decide the right time to buy or sell your units. Think of NAV as the price tag for one unit of debt fund. It changes every day based on how the bonds are performing. If the bonds do well, the NAV increases. If they don't, the NAV drops. It's like mangoes at the market. If they're in high demand, the price goes up. If the demand drops, the price goes down. As an investor, your goal is to buy when the NAV is low and take advantage of its increase in value over time. When a fresh batch of juicier, better quality mangoes, like the higher interest bonds, arrives on the market, the older, less attractive ones lose their appeal. As a result, the price drops. Similarly, when newer bonds offer higher returns, the value of existing bond decreases, which can lower the NAV of debt funds that hold them. This works in the same way as rising interest rates. When the rates goes up, the price of existing bonds tends to fall because newer bonds can offer better results. This works the same way as rising interest rates. When the rates go up, the prices of existing bonds tend to fall because newer bonds can offer better returns. As a result, the NAV of debt funds which hold these bonds also drops. Essentially, when the interest rates rise, the value of the bonds in the fund decreases, which directly impacts the value of your investment in the fund. Debt fund NAVs update daily based on the performance of the bonds and changes in the interest rate, giving you a real-time snapshot of how your fund is performing in the market. For this episode's task, think about something you bought and later sold for a profit. A gadget, a collector's item, or anything else. Write about it in your debt fund diary. How did you decide the right time to sell? Reflect on how timing played a role in your decision making and think about how this applies to investing. Drop your story in the comments. I'd love to hear your experiences with timing. I hope today's episode clarified how buying and selling debt funds work. Next time, we're talking about bond investment strategies. See you in episode 7.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.